Hi, by popular demand, I'm going to do an analysis video today on the company JD.com. And for those of you who recommended me take a look at this company for you, well, I hope this video lives up to your expectations and the quality that you've come to expect from my videos. And for those of you who are not familiar with JD.com, well, they're the second largest e-commerce website in China, and they sort of rival Alibaba. And this isn't just some small rival to Alibaba. They've got a market capitalization over $100 billion, so they're quite a big player in the game. Now, I think why a lot of people have been recommending me do a video on JD.com is because the share price has just taken off and it looks like it might just keep going. But by the end of this video, we will all know if this company is a good company to invest in based on my analysis of the future, the current financial position, and the price. And if you're new to my channel, well, welcome. My videos are about investments that anyone in the world can make. So today we're back in the Chinese market looking at JD.com. And a lot of this video today, we're going to be comparing JD.com with Alibaba and Pinduoduo, because that's the market that they're playing in. Now, Alibaba controls 59% market share of China. JD.com have about 17% and Pinduoduo at about 7%. Now, I'm sorry if I'm saying Pinduoduo wrong. I have no idea how to pronounce this word. Now, some will say that comparing JD.com to these two companies, well, it isn't fair as they have different business models. But I think that is exactly why we should compare them to see which business model is the best for the e-commerce market of China. So Alibaba is more of a listing website. They don't have fulfillment centers and warehouses. Now JD.com, well, it's more similar to say Amazon in America, where they fulfill orders and run tight margins. And then we got Pinduoduo, and this is more of an online discount shop where big bargains can be found by shoppers. It reminds me a little of Groupon, but for products. And as you can see, with operating margins between Alibaba and JD.com, well, it is a far more profitable business to be not fulfilling inventory and dealing with logistics. Now, Amazon has the same model as JD.com, and Amazon will tell you, well, that's how to best serve the customer. JD.com, well, they promote their same day or next day delivery service, and that's very similar to what Amazon does, and that's because that's what the consumer wants. So maybe the low margins aren't really the key takeaway here. What the key takeaway here is whether the customers are happy. But for me, this is a risky play. See, the tight margins for JD.com make investing and growing more difficult without raising more money and getting into debt. High profit margins like Alibaba are simply more resilient and better businesses than lower margin companies. So JD.com have some very strong partnerships. Tencent being their largest shareholder who owns the WeChat messaging platform. Well, that's a very important customer because JD.com can integrate their services into that WeChat platform. So this is really important because now Tencent and JD.com can work together to sell products on their social media platform. So this type of partnership is a little bit like if Amazon was to partner up with Facebook. Not to that scale, but that's the kind of relationship it would be. Baidu, Walmart, and even Google have actually invested interest in the company as well. So the support for JD.com to challenge the big rival in Alibaba is actually really strong. JD.com are also moving into cloud services to diversify their revenue streams, but they are far behind Baidu, Tencent, Alibaba in this space. But a good sign is that they are seeing growth in this area. They have seen about a 40% growth rate in their cloud services year on year. Now, annual active customers are accelerating. And this is a very positive sign for JD.com and a big reason to be interested. But we have Alibaba's active customers growing at 15% last quarter and JD's active customers growing at 10% last quarter. Now, that is big growth for both companies, but the faster active user growth from Alibaba does concern me that users might prefer Alibaba over JD. So here are the latest results from JD.com. Revenue has gone up 33% for the quarter to $28.5 billion. Earnings per share is up from 33 cents to 50 cents per share. That's a big jump. The merchandise sector of their business is up 45%, and their new sector, JD Health, is up 400%. Now, granted, it's from a low base. Back in 2019, the big concern was that growth was actually slowing and the costs of the business were rising. But the last few quarters have shown improving growth again and a reduction in costs. Now, the company is getting big enough where they're kind of reaching that maturing stage, and I don't think that's a bad thing at all. Diversified revenue, cost reduction, and a growing subscriber base, well, there's a lot of positive signs here for the future. Now, what I don't like about the market that JD.com is competing in is that the competition, well, is fierce. You've got Alibaba, you've got this Pinduoduo as well, gaining market share. And look, it's just a really tough market to be in. Alibaba is the clear leader at the moment, and I'll be honest, it's really difficult to try to predict what's going to happen in the future here. But on the other hand, JD.com is a smaller company and they have some very strong partners, so maybe there's more upside potential with JD and a better play on the Chinese e-commerce market as a whole. But I'm not entirely sure. I think we need to go have a look at the financials and also go have a look at its intrinsic value. Now, with any business, to check the financial strength of the company, we need to look at these three areas. Can they handle their debt? Are they growing? And are they a well-managed company? Now, don't worry about the terminology that I'm about to use. Just sit back and relax and just remember that this isn't all science. It's a little bit of art and science, and you've got to get a bit of experience here. And if you haven't done so already, please subscribe to my channel so you don't miss out on any future videos. Also, by watching more of my videos, you will get more of that experience. Now, it's really important to look at the company's debt, because if the business was to completely stop for some unknown reason, maybe some crazy government decision, I don't know, maybe something goes wrong with the internet, I don't know, but we want to make sure that if they have low debt, they'll be able to survive. So to see if the business can handle its debt, I go through the debt to equity ratio and the current ratio for the business. Now, this is the debt to equity graph, and I want to see this below a 0.7, and JD.com, well, is well under that. This is the current ratio graph, and I'm looking for above a 1.5 normally. Now, even though the current ratio isn't above a 1.5 at the moment, because their debt to equity was low, I think that this lower current ratio isn't going to be a problem. So I'm going to give them a pass. But we definitely want to see this number above a 1, which it is. It's not ideal, but it's good enough for now. So in the finances, to check for growth, I look at the book value per share, the earnings per share, and the operating cash. This is the book value per share, and it's solid growth here from JD.com. Very good to see. Now, this is earnings per share, and it has just turned positive, which is a good sign, but not much of a history here. I want to see more long-term earnings per share performance than this. But if we use other metrics like we looked at earlier, like active users growth, well, it's clear the company is growing. Now, although it'd be great to go sit in with the management team, we can't do that. But fortunately, there are some telltale signs in the financials to see whether the management team are making some good decisions. So I'm going to check the return on equity, the free cash flow, and how much cash they have on hand. So I want to see the return on equity above a 15, as it shows management are improving the value for the shareholders. So JD.com at a 14 is actually not that bad, but like the earnings per share, there's not much of a history here. This is JD.com's cash in the bank, and as you can see, it's been improving, and I like seeing that. This is the free cash flow graph, and free cash flow essentially is what's left over for the business to either give to its shareholders or pay down some debt or do something good for the company. And as you can see, there's not much consistency here with the free cash flow either. So I think we can only give them a half mark. So now we're going to look at what the intrinsic value is for JD.com. Now, if you want a copy of this exact same calculator that I'm using, it's free and it's in the description below. So the cool thing about this calculator is it takes in the expected growth rates of the future, plus how much money it's currently making, and it gives us what we should be paying for it in today's value. Look, it's a really powerful tool, and it's really helpful when making decisions on whether something is overvalued or undervalued, because you can play around with the growth rates here to see what you think might be a more feasible option for you. Now, what I've done is I've averaged a lot of different analysts, and we got to about, it's actually supposed to be about 25%, but I think it's going to be closer to 30% for the next 5 years, and then 15% after that, from years 6 to 10, that gives us a pretty good average for the next 10 years for the company's growth rate. Now, at the moment, I've got the discount rate at 8.5%. It's just rounded it up to 9%, but that's what we're going to use as the like a fair value price, like what we think the company should be worth right now. Now, I'm using 15 as the multiple we could sell it for after 10 years. Now, because it's a tech company, it warrants probably quite a high multiple, and 15 is high enough. Now, for the cell that I'm currently in, I've gone and found actually the free cash flow number. It's a more conservative number. I like to use free cash flow if I can. Or you could use the operating cash flow minus maintenance capex. It's a lot harder to find that number though. And the shares outstanding right now is 1,499,000,000. Now that's actually been increasing steadily over the years, which is not a good sign. Now we've put all this data in and it's come to a buy price of $651. Now that's not right because that's in Chinese yuan, so I've had to turn that into US dollars, and that's what the yellow cell over here is. So that's 97.6, call it $98, right? Now that's intrinsic value. We have no margin of safety here. Now to put in a margin of safety, what I'm going to do is I'm going to change the discount rate, and let's do it 20%. Now 20% is about what I would use for, say, Google or Facebook or something like that, maybe Alibaba as well. And using this discount rate, it's not as good as I could go higher if I wanted to, a higher discount rate, which give us more margin of safety, but I think we're okay with 20% here. So the buy price now is about $42. That would give us a good margin of safety, and that would be the price that I'd be looking to buy at. Now this is just my estimate, so please play around with the growth rates and see what numbers you do get. Because if you think things are going to be far better than what I think and what the analysts think, we'll just put in higher growth numbers. Now, please just don't forget the margin of safety, because no one can predict the future accurately, and you do want some sort of breathing room. Now, the current share price as of the end of September is around about $74, depending what day you're looking at it. So JD.com is actually under intrinsic value, where I think it's about $98, but it's nowhere near the buy price that I'd be willing to pay because I want a margin of safety. So right now, do I want to invest in JD.com? Now, I'm not rejecting JD.com solely based on the share price. I'm actually rejecting them because I'm not that confident with the future outlook. See, I just don't know what's going to happen in the space, and Alibaba being such a big rival and have such higher margins, I think they're a better play into the e-commerce world of China. But on the other hand, I do like that their active users growth rate is accelerating, so there is a lot of upside potential here. But then again, the share price is just too high anyway, and I've already factored in a high growth rate of 30% for the next 5 years. That's high. So I think if we were getting a bargain price like that $42 that I found earlier, and the current financials stayed as strong as they are, well, I think they are investable at that level. Now, I'd love to hear your thoughts on this investment, because I know a lot of people out there are going to think that JD.com is a fantastic investment and I'm crazy for letting it go. But hey, if you agree or disagree, it doesn't matter. I hope you just hit the subscribe button for me anyway, because you enjoyed this analysis, and I will see you in the next video.